Here's something I hear all the time. We put everything in a living trust, so we don't have to worry about federal estate taxes or IRS Form 706. I wish that were true. It's not, and getting this wrong can catch a family completely off guard. I'm Shanti Sorjono, a California probate and trust real estate specialist. I work with executors and trustees on this exact question. Does a trust have to file IRS Form 706 more often than you'd think? So let's get into what this form actually is and who really has to file it. Let's talk about IRS Form 706. It sounds intimidating, but it's really just the federal estate tax return. Formally, the United States Estate and Generation Skipping Transfer Tax Return. And here's the first thing to understand. It's filed for the person who passed away, for the decedent's estate, not for the trust as some separate legal entity. The trust doesn't file this. The estate does. So what does Form 706 actually do? Three things. It reports the total value of the deceased person's taxable estate. It calculates any federal estate tax that's due. And it lets the executor elect portability. That's the legal term for letting a surviving spouse use the deceased spouse's unused federal exemption. That unused amount has a formal acronym, DSUE, the Deceased Spousal Unused Exclusion. Put plainly, if your spouse passes away without using their full exemption, you may be able to use what's left. And that can reduce or even eliminate your own federal estate tax down the road. So who actually has to file? Generally, Form 706 is required when the estate exceeds the federal filing threshold. For deaths in 2026, that threshold is $15 million. The gross estate, plus adjusted taxable gifts, plus certain prior gift tax amounts. And it's a moving target. In 2024, it was $13,610,000. In 2025, $13,990,000. In 2026, $15 million. These exemption amounts are adjusted periodically under federal law, so they can keep climbing. But here's what surprises a lot of people. You don't need to be anywhere near $15 million to want to file Form 706. Even a much smaller estate may file for one reason, portability. Why bother? Because preserving that unused exemption protects the surviving spouse. If that spouse's own estate grows later, maybe assets appreciate, maybe they inherit more, the unused exemption from the first spouse can reduce or eliminate their future federal estate tax. So sometimes filing 706 is strategic, even when no tax is due at all. Now, the question I hear constantly, does a revocable living trust file Form 706? Here's the truth. The trust itself never files anything. When the grantor dies, a revocable living trust typically becomes irrevocable, but that doesn't make the trust a filer. What actually happens is this. The assets held in that trust are counted into the deceased person's gross estate when you're deciding whether Form 706 is required. If the total taxable estate crosses the threshold, or if the executor elects portability, the executor files Form 706, reporting both probate assets and trust assets together. One return, everything on it. Let me make this concrete. Meet John. His home is in his living trust, worth $1,500,000. His bank accounts in the trust? $800,000. A brokerage account at $3 million. Retirement accounts at $2 million. Total gross estate, $7,300,000. That's below the 2026 threshold of $15 million. So Form 706 generally wouldn't be required, unless the executor wants portability for a surviving spouse. And here's the point I really want you to feel. Most of John's money was in a living trust, and it still all counted. Every dollar. The trust didn't keep it off the estate tax radar. Now let's talk about irrevocable trusts, because this one is more nuanced. Does an irrevocable trust file Form 706? It depends. Some irrevocable trust assets land in the taxable estate, others don't. It all comes down to the trust's terms, whether the deceased kept any ownership or control rights, and how federal tax law applies. That's technical enough that an estate planning attorney or a CPA needs to make the call. Please don't guess on this one. So, what actually counts in the gross estate? The IRS looks at everything the deceased owned or controlled, not just the assets crawling through probate. Real estate, living trust assets, bank accounts, stocks and bonds, business interests, retirement accounts. Yes, they're in the gross estate, even though they carry their own income tax rules. Life insurance proceeds in certain situations. Vehicles, jewelry, artwork, collectibles, other personal property. If you owned it or controlled it, the IRS wants to know about it. Let me show you what crossing that line looks like. Meet Mary. She dies in 2026. Her home is in a living trust worth $4,500,000. She has an investment property at $3 million, a brokerage account at $4 million, retirement accounts at $2 million, bank accounts at $800,000, personal property at $200,000, and a life insurance policy included in her taxable estate at $1 million. Added up, $15,500,000. That's over the 2026 threshold of $15 million. So Form 706 would generally be required, even though most of her property was sitting in a living trust. The trust didn't change the math. And that brings me to a myth I really want to bust. A living trust does not avoid Form 706. It avoids probate. Those are two completely different things. A revocable living trust can help your family skip the court process, keep things private, and make the transfer smoother. But it does not automatically avoid federal estate tax reporting. So many people believe that putting assets in a living trust keeps them off Form 706. It doesn't. That misunderstanding can be costly, so let it go. While we're clearing things up, let's separate the three IRS forms people constantly confuse. Form 706 is the federal estate tax return, the one we've been talking about, filed by the executor when it's required. Form 1041 is the income tax return for an estate or trust that earns income after death, filed by the estate or the trustee. And Form 1040 is the deceased person's final individual income tax return for the year of death. 3 different forms, 3 different jobs. Don't let them blur together. Now, if you're in California, here's some genuinely good news. California has no estate tax, no inheritance tax either. But the federal estate tax rules still apply if the threshold is crossed or if the executor elects portability. So living here doesn't make the federal question disappear. So here's what I want you to remember. A trust does not automatically trigger Form 706. The form is filed for the deceased person's estate, not simply because a trust exists. For 2026, the threshold is $15 million in gross estate, or the executor may file to elect portability for a surviving spouse. Living trust assets still count toward the gross estate, even though they skip probate. And most California families fall under that threshold, truly. But every family is different, so executors and trustees should loop in a qualified CPA or estate planning attorney to sort out whether Form 706 is required or whether it's worth filing anyway for portability. One more time, because it truly matters, this video is general information only. It is not legal, tax, or financial advice, and I am not an attorney or a CPA. Please speak with a licensed probate attorney or a qualified CPA about your specific situation. And if you're an executor or a trustee here in California working through an estate with real property involved, I offer a free, no-pressure consultation to help you understand exactly where you stand. I'm Shanti Surjono, and you do not have to figure this out alone.